The things I'm going to touch on is obviously, you know, where your mind should be every day sitting down in front of the charts. You have to have some reason to be in the charts doing it. My suggestion to you, if you maybe you've watched some of my videos, maybe you watched a lot of my videos, and you just don't know what to do or where to begin or what to do right now. What do I do right now? Because it's very daunting seeing how many videos I have, and I get it. It's meant to be a compendium, meaning it's like it's my entire encyclopedia of what I'm willing to give to the public. So you can go in, you can build your own model. Seeing live price action, watching data tick without the benefit of knowing what it's going to do is exactly what you as a trader are going to have to encounter. Every single time you sit in front of the charts, you don't know what's going to happen. And right now is a wonderful learning experience because the climate is so statically charged. It increases the level of responsibility on your part as someone that wants to engage in these markets because they're very risky. And now add to it the increased level and amplitude of uncertainty where anything can happen. A bomb drops and then boom, everything starts changing rapidly. And that fear and that rush will be injected into the marketplace. Price will do what it's going to do because it's coded to do it based on time. And time is essential. It's the first hallmark to when and why a market should produce a displacement, a run, whether it be impulsive, whether it be retracement, whether it be anything. It's always going to be delivered on the basis of time. It's going to move at a specific time or a period of time within 20 minutes. That's a macro. This first lecture is number one, your mindset going into it, and then how we set up our charts, what we're looking for to start a baseline to determine what type of trader you're going to be. Because it's real important that I don't push you into a mold. Caleb needs to tell me what he wants to do. And then once he finds out what that is, and I'm going to teach how to determine what that is for yourself today too. Because if you don't have that direction, you're going to waste a lot of time. You're going to chase things. You're going to worry about things that are not important. It's going to actually slow your growth. It'll slow down your productivity and it'll hold you back. And there's nothing more challenging than feeling like you're not doing enough in trading. And we're going to show how you develop real skill. That way you can produce a consistent baseline to evaluate, do I want to be a trader that focuses on long-term trend directional moves and only trading in that direction? Or do I look for periods where even in those long-term daily and weekly movements, where can I see potential intermediate term or short-term retracements? Because I understand the trend may be going in one direction, but it's something I don't trust to be a part of because maybe you've tried entering on trend models and they burn you and they retrace deeply against you and you feel more comfortable fading those types of moves. I'm going to teach on that topic as well. So that way you'll have reversal patterns, turtle soup, real turtle soup. The idea of knowing where the market should retrace deeper, maybe even the basis of retracing to set up a long-term trend model entry to get in sync with that daily and or weekly direction. It's real important that you have some input initially. We're in that gray area initially where you have the responsibility, because if you don't do this part correctly, everything you do after this holds you up. It just means that you screwed up and didn't listen to this first lesson. You have to determine what you're going to do as a trader. And then whatever that is, you bloom there. You plant yourself in that. You don't care what Caleb does. You don't care what anybody else is doing. I encourage my students to get a secondary income because that passive secondary income can be a way of maneuvering the fear and anxiety away from you needing to be perfect in your trades, which is absolutely toxic. You cannot have that mindset as a trader. You can't do that. You have to invite the opportunity for you to be wrong. It doesn't sound productive. It sounds counterintuitive to say, okay, I invite myself to be incorrect about what my assumptions are about price action right now and when I go into a trade. When you go into a trade, as soon as you enter that trade, you've completely given the responsibility of the outcome to the market. You don't have any assurity that your stop loss is going to get you out at that price. You don't have that guarantee. The market could happen, especially in the conditions we have right now, where a bomb, a war can break out, boom, unexpected events, bang, you have a huge gap. And it could gap way beyond where your stop loss is. And guess what, folks? That risk is always there. That's why every brokerage firm makes you sign these risk disclosures, because that's what can happen. And for individuals that trade with extreme leverage, it kind of promotes the wrong idea. and preparing yourself. You have to absolutely prepare yourself to learn properly. And if you don't have that mindset going in, everything you focus on will be the wrong things. They'll all be doing things that are moving towards consistently profitable. That's the number one goal, whether it be learning from me or learning from anyone else. It's not a task that is outside your grasp. Right now it might be, but if you do the things that I'm going to suggest to my son, and he doesn't rush to go and try to pass a combine. He doesn't rush to get a payout. He doesn't try to trade every single fluctuation in price. He doesn't try to do everything that I've made available to all of you, which is what most of my students try to do. They all dabble too much. And if you simply go through this simple question and answer for yourself right now, the type of person you are right now, are you someone, if someone says to you, I don't think this is possible, or I don't think that you can do that, are you someone that says they're probably right? Or I'm going to show this person they're wrong, and I'm going to show them 12 ways why they're wrong? Because right now we're going to divide you all as an audience. Because either you're going to be someone that's going to be influenced and held back by someone else's opinion or suggestion on you, or you've watched other people receive criticism and then you somehow latch onto that like it was told to you, and you feel emotional about it and you have a psychological response and it was never directed to you, but you personalize it to yourself. That's very telling. That is a barrier for you as a trader. You may not realize it right now, but Friday, I'm going to cover the contrasts of all that. You may not know the answers to these things right now today because you want to think about what I'm going to tell you. And you all want to be able to say, yeah, I want to be the guy or gal that says, if you can't do this, I'm going to prove it to them. Chances are every male listening is probably going to be wanting to do that. But in honesty, all of you aren't really like that. You're influenced by other people's opinion, and it makes you feel unsure about yourself. It may be causing anxiety. It may feel embarrassment, or you have that spark, that inspiration to now do something because it's a challenge that's been laid in your hands. I am the person, my personality is you tell me that can't be done or that I can't do something. My mind immediately switches on. Like I'm in there looking for every way to come back at them and say, this is how you're wrong. And I want to bury them in it. That's my mentality. And that's not a strength. That's just how I interact with outside influences. That stems from a childhood that I had no control over the factors and environments that I was left in, which were dangerous and they were hostile. So as an adult, now I seek control all the time. If I don't have any control over it, I have no interest in it. That's my disposition. That's how I am. You may not be that way. You may be very, very passive, and you may be very lethargic in terms of responding to things that are met as a challenge towards you. And you may be using that very perception about the marketplace, and that's your hindrance. That's the barrier that you have to, if you have that mentality, you're going to have to break through that. And it's not going to be easy for you. Because what you're seeing is most people fail doing this. Most people can't even determine where the market's going to go, let alone get in it without having managed risk appropriately. That's the majority. That's the truth about this industry. Very, very, very few people can do this consistently. You know this, but you're still willing to watch videos. You're still willing to try to practice and dabble because you're waiting for some kind of magical thing to occur where it clicks for you with no real effort. With no real study, with no real logging and journaling, you think it's just going to happen for you. That's not realistic. Part of this mentorship will be using the tools and resources of journaling properly. But what is it you're supposed to be journaling anyway? The very first step is for you to determine where you are mentally and then determine ahead of time, preparing yourself what adversities are going to be in front of you. For the folks that are saying, okay, you say I can't do this, or someone else is saying that you can't do this, you're going to go at it 100 miles an hour. That's good that you have confidence in yourself, but the problem is you're going to overstep that and become overconfident. And then as soon as you're met with that first adversity, it's going to really hold you down. And it's going to cause you to second guess the next step of stepping out there in faith and determining what it is that you're trying to do or practicing. And then what you end up doing is the initial strength is I'm strong, I'm confident, and nobody's going to tell me I can't do it. I'm going to do it better than I would have done it if they would just invited me to do it casually. But now because they said I couldn't do it, I'm going to do a superhuman Olympic feat of it. And by doing that, what you end up doing is you increase the level of adversity, the difficulty. You put a time limit on it, which is the worst thing in the world to do. Let's say the first time you sit down and you try to test something and it takes off and runs like 150 handles in the NASDAQ, what's that going to feel like for you? You're going to feel ecstatic. You're going to be excited. And you're going to feel like, wow, this is a whole lot easier than I thought. And that's wrong. But see, that's the problem with these 20-year-olds that teach. They want you to have the emotional stimuli, because that emotional stimuli gives you a rush. It's dopamine. It gives you that physical feel-good butterfly moment that does not last. You all think that I got to get my combine passed and then I can start trading on an account where I can make profitable trades. So you're willing to do everything and anything just to gamble to get it passed. And then once you get there, you think it's going to be easy, when it becomes extremely much more difficult, because now you don't want to lose that past funded account. And every candlestick looks like a foreign language to you. Even if you understand certain elements of reading price action, you won't feel comfortable pushing a button, because now you're thinking, if I get in right here, what if it goes down to here? Or what if it goes to this high here? Where do I put my stop loss? I don't want to get stopped out, but I got to use a stop. And see, what are you doing? You're trying to protect yourself from a losing trade, because that losing trade, even if it's small in denomination, if it's small in amount of dollar risk, the lasting impact and the depths of how far it digs into your backside, it's monstrous, because you're creating a demon. You're manifesting your worst adversary, because you didn't do everything that I'm suggesting as a starting point right now. It prepares you for this. What do you think basic training is for? It's to get the person physically fit, to get them introduced to constant disruption, constant mental fatigue, so that way they're not shell-shocked when they get out on the battlefield and freeze up. But initially, when you first want to do this, you want to be trading with a micro. I want you to hear this, okay? And I mean this sincerely. If you're trading more than one contract of a micro with 3,000 cushion and you're not consistently profitable and you don't know what you're doing, you're absolutely gambling, and gamblers don't last long. You can gamble. There's a lot of people over the years with all these funded account companies. I've had paid mentorship students that have gone through it. They've passed combines, they got paid out, and then they lost it. And then it completely undid them. And they can't get it back, and they can't pass another combine. Why? What happened? Now they have mental baggage. They have scar tissue. And now the lessons I taught in those Twitter spaces, the depths of where I was trying to take you, a lot of you haven't gone to those places yet in your trading. So the lessons just went right over your head. But for anyone that has actually tried to trade with real money, or had a live account or a funded account and has taken withdrawals from the marketplace, and then they lost it, now those Twitter spaces, now those talking points, they are much more meaningful, and they're impactful, and they are helpful. And I don't want any of you to be codependent. I want you to be able to walk out there and say, this is what I see potentially unfolding in the marketplace today. So I'm going to build an idea on how the market may, in fact, set this up. And where's the draw on liquidity? Where's the market likely to go? What are we looking for in terms of potential expectations and where the market could trade to? And that could be something like this. We have relative equal highs right here. Very simple, smooth price level. The market's gone down a lot, several thousand handles. Okay, we had a huge gap, new week opening gap here. So where we settled on Friday and where we opened on Sunday at 6 o'clock last night, that new week opening gap, that's a draw on liquidity. But we don't need it to trade all the way up to there. So where is the low-hanging fruit objectives for just short-term bias? This is what I'm teaching you, Caleb, initially. I want you to think about where the market could draw to right now, where it could go to next. And what that does is it gives you something to focus on. And it also gives you a way of measuring every individual candle's formation and what your expectation is as it's forming, and what the next candles should do and how they behave and what it feels like for you when you do this. Because whether you want to admit it or not, when you're first starting, the majority of your time is going to be spent in uncertainty, in times of confusion. It's going to be fearful. It's going to feel very anxious. You'll feel anxious. You may even start feeling body symptoms of tingliness, lightheadedness, feel like you're going to get sick. And you may still only be in a demo, because what you're doing is you're elevating the outcome to a level that is not expected. You don't need to put that much pressure on you. In fact, if that's how you're thinking, it's normal for you to feel that way when you first start trading with a real account. There's no way around that first trade with real money. That fear and that anxiety is something you just have to engage in. And that's why I say, as soon as you get a live account, first thing you should do is flip a quarter, lowest leverage. If it's tails, you buy it. If it's heads, you sell short, or vice versa. And you do the smallest leverage and put a 15-point stop on it. and just let it happen to you and break the ice and let it go. But see, a lot of you want your first trade to be a winner because you think it's somehow an invitation for failure if your first trade with your real account loses money. But the way you overcome that is spending time without pushing a button, studying where price can go, and that's this. We have this short-term high here, post 830, meaning after we had 830, right here we have 836. So the market went below these relative equal lows. So any liquidity below that, they disrupted that and then took it above this short-term high. Took it above this short-term high and traded right inside this fair value gap right there. So when you're watching price, Caleb, you're looking for how the market maneuvers and trades and books between obvious price levels with old highs, old lows, and inefficiencies. They're the only two things you're worried about. You're not trying to predict a direction on the day. You're not trying to be right about 50 handle runs. You're just studying, observing. This down close candle here, after taking out the liquidity, and then we have displacement here. Displacement is where the market runs against a pre-session, pre-day, pre-trend or price swing direction. In other words, it's a counter move to what's already been in play. So the market has dropped here, and then we moved aggressively above this short-term high. This high being traded above there, we go back down to this down close candle. That down close candle is a order block. We have displacement, it took liquidity, and the market has been one directional. Now, what makes that an order block specifically is it has happened post 830. Now, it could have formed right at 830 because 830, the algorithm will start spooling for liquidity or inefficiencies, one or the other. Now, in the beginning, you're going to want to know, because you're probably asking right now, can you just tell us what is it going to reach for? Is it going to go for an old high or old low, or is it going to go for a fair value gap above or below? It's going to go for both. Is that complicated? No. The only thing we're doing is we're sitting down at a time when the market is most likely going to do this. And it will do it unless some unexpected event where manual intervention steps in and you don't know and I don't know when that's going to happen. What does it look like when the market just starts going and it starts going one direction and it doesn't stop? Intervention is, think like FOMC, CPI, non-farm payroll, where if you're wrong, if you're offside right when it hits the market, you're dead. That's what manual intervention looks like. They're many times untradeable. It takes off so fast, it's unreasonable for you to assume that you can trade that once it starts because you're literally chasing the wind and you're never going to catch it. So when we look at individual setups like this, you want to sit down in front of the marketplace right before 8:30, preferably 8 o'clock, and you want to look at where the highs and the lows are in deference to the 1 minute chart and the 15-minute time frame. Here's what 15-minute looks like. And if you look at where we came from, see this high at 7 o'clock in the morning? That's this high right there. See it? So this chart, this larger chart here is the 1 minute, 15, 5, 1 minute. Those are your first three time frames to worry about. The levels and inefficiencies on the 15-minute time frame, the 5-minute time frame, and the 1 minute time frame. If you're brand new and you don't have a trade period, you don't need any other time frame to do what I'm going to teach you. This is what you're doing. You're studying price at specific times of the day. If you're not writing this part down, you're blowing it already. Between 8 o'clock and 8:30 in the morning, New York local time or Eastern Standard Time. This is always, absolutely, without fail. It's never not going to do it. It's always, every single effing day, it's going to do this very thing. It's going to do it because there is an algorithm and it does this to spur on emotional interest or tangible orders that are actually sitting out there. Real orders that are sitting above and below or inside of inefficiencies where the market needs to offer fair value to the marketplace. So what is it reaching for? It's reaching for old highs, old lows, and inefficiencies. That's the fair value gap. Once we know that the market is likely to do these things, that's a characteristic. It's an algorithmic characteristic. You don't need anything else besides this element as a foundation to what you're trying to trade, and you can make all the money you'd ever want. Right now, you want the daily bias and you want to be able to buy below the open and hold for the whole entire day. But are you really doing those things when you try to trade? No. As soon as you get 10 handles, you start struggling with holding on to the trade. You're paranoid. That winning trade just fell into your lap. I need to secure this. But then you're thinking, oh, wait a minute, I'm supposed to be holding for the daily range. And now you're wrestling. It makes you feel nauseous. And if anybody tries to talk to you, even if they love you, your dog comes over and nuzzles up next to you. Any other time, you're like, oh, this time, get away from me. Can't you see I'm trying to worry about this 10 pip handles move? The weight of the world is on my shoulders right now. And you're coming at me with this? You know what it means. You're stressing out. The reason why you feel that is because you don't know what you're doing. You haven't done this part long enough where you're completely desensitized. I'm doing this exercise to get comfortable with anticipating price moves. I'm getting comfortable with not knowing what it's going to do next candle, this candle, 5 candles from now, but I think it's going to draw to specific price levels. So if it clears that short-term low we talked about, what's it going to reach into? We have this inefficiency here. How long does it take to do that? And then you record, you screenshot this, and you say, okay, well, it took 6 candles from this volume imbalance to run above this short-term high and get into this. A fair value gap that has a down close is a SIBI. A fair value gap that has a up close is a BISI, buy side imbalance, sell side inefficiency. So what you're doing is you're measuring, because you have zero baseline experience. You have no continuity in what it is you're reaching for or looking for in price action. And you study how long it took and you record this many minutes. And you also are honestly going to record in your journal within the screenshot, like maybe over here or somewhere over here. You're going to record what it felt for you physically. Were you anxious? Did you second guess that it was going to run there? Did you feel excited the entire time? Were you impatient that you thought it should have moved there sooner and faster? Did certain candle formations cause you to doubt it? Did you have a point at which you thought that it was given another opportunity, offer another entry like on the pyramid? Pyramiding should not be part of your repertoire yet. That's something that you need to be doing maybe a year after trading with one contract. Oh, come on. You want to learn how to do it correctly, this is the way you do it. There's all kinds of time and opportunity for pyramided trades, but you first have to get good at trading with one micro contract, because what that does is it removes, this is the only thing you can do to fend off the greed and fear. You can't blow the account if you trade with one micro and you only take one trade a day. It's physically impossible for you to go out there on day one and blow the account. But see, that's what your subconscious is fearful of. I don't want to blow the account. I don't want to have a big losing trade. I don't want to go into big drawdown. Okay, that's easy. Don't over leverage your account and don't take more than one trade a day. If you want to be able to do it correctly, you have to do things with a process. There has to be a logic behind it. There has to be some measure of rule-based thinking, and then you have to adhere to that. If you don't want to adhere to rules, I promise you, you're going to lose, you're going to fail, you're going to blame everything but you. I know this because I did the same thing as a 20-year-old. As soon as you enter these markets, you've entered the jungle. And honey, everybody's hungry. And if you offer it up on a silver platter, they're going to take it and eat it. And you can't be upset about it. It doesn't matter how anybody else trades. It's, are you liquidity right now? Because if you're liquidity, you're lunch. I go in, I'm looking for reasons why the market will trade to this level, why it could potentially trade to this level, but I don't need it to trade. For instance, this is the draw on liquidity. Draw on liquidity is just a initial reasonable assumption on our part to determine a directional move that could unfold. It does not mean, and it does not define the be-all, end-all target. In plainer terms, the market's probably going to keep moving until it gets to this level. It doesn't mean that it can't have retracements lower. It doesn't mean that it can't make a lower low than it's done here. Highly unlikely, but it's still an initial idea. So when you're first trying to learn how to read these markets, when you're first trying to determine where the market's likely to go, you have to strip away everything that you're trying to force into reading every single individual candlestick. When we're looking at price, as a brand new student not knowing what to do, you want to make this kind of like a game and a discovery, something fun. Not a video game, okay, but it's a game of determining, does it have what it takes to move to these highs here? A way of saying it to yourself that's very disarming. It's okay. I see how this is smooth. These two highs are relatively equal. That looks like a real nice, obvious flat space in price. We don't see that same flatness down here. You see that? You have two sharks in front of you. One has had its teeth removed. Well, that would be represented in something like this. This is the shark with no teeth. It's basically got gums. Down here, there has been a shark attack. How do we know that? Because we can see the wounds from the teeth, the jaggedness. And now it's going to another frenzy or feeding. Where is that? Well, we've just created one. We have this high here that's really close to this one. You see that? You observe price action and you're looking for areas that look real smooth and safe, where they say peace and safety, sudden destruction comes upon them. Any time that you're looking at price action, and it doesn't matter what time frame you're looking at, it does not matter. This principle is always true. The market will go to an area of smoothness for the purpose of disrupting any orders that would be resting above or below it. We've already mentioned down here, don't be discouraged if you can't watch this stuff real time and see it or outline it in advance. It's okay for you to come home for work and look at your charts after the fact and go back and look at this and study it, you have obviously the benefit of hindsight initially, but you don't want to stay in that very long. So you're going to have to procure yourself some instruments that will allow you to watch price action, not with market replay. When we're looking at it initially, you don't have to see this real time to get a collection of screenshots for your journal. But if you don't do this and journal and screenshot and annotate your chart and study how long price runs took place, how many candles did it take to move there, was there any kind of formation in the price delivery that would have caused you to not trust it unfolding? What we're looking for always, the first thing that you're looking for, Caleb, is where is the market smooth on the 15, the 5, and the 1 minute chart. It's not complicated at all. It's real simple. What does it look like to be smooth? Well, when you have price levels that create highs, like this swing high here and this swing high here, they're real close to one another. See that? When you're looking for relative equal highs, here's your secret weapon for it, okay? How do you know it's a high probability relative equal high that's likely to get swept or traded through? What differentiates that from any other? If you have two swing highs, if the one to the left is slightly higher than the right, you have a very, very high probability that they're going to want to take it above there, just like you see here. We have a high, and then the swing here happens to be just a little bit lower than that one. Here's what's going on. This is called priming. Priming is where you continuously create, inspire, or manipulate the expectations of a large number of investors. And they think, oh, it's going to go through that high. But then there's a lot of folks that don't want to see it go there because they went short. So when the market goes up here and stops and turns down, what that does is it creates a sympathetic sigh. The shorts are relaxing. If the shorts are relaxing, what are they saying? They're saying that this is now what? Resistance. So anyone that takes a new short position, where are they going to think that the safest place to put their stop loss is going to be? Right above these highs. Why can we trust that they're likely to take that relative equal high out? Not that it will that session that you're trading, but it's high probability that this will be swept when the second or the one to the right, that swing high is lower than the one to the left. That frames these two as relatively equal. Same thing is occurring here. We have this high here, this high here, this one being slightly lower than that one. So when the market went up like this and we had this drop down, what that causes is a sympathetic sigh. What is that causing people? Anyone that went short here, they feel like, okay, that's scary because it almost went to that high where their stop loss would be if they're trying to go short in this area. See that? So what do you think it looks like when we have relative equal lows? What would be a high probability relative equal low that the market is likely to draw down and go below? It would be a low that has a slightly higher low. In common terms, it's referred as a failure swing. What I'm teaching you is how to identify in price action where the algorithm will refer back to and why. What are the central tenets as to what the algorithm is referring to at a specific time of day, most important. And then it refers back to these because it sees this high based on time, and then the high prior to that one is here. So it's very simple for the algorithm to call that information as an array and say, okay, this high was at this time, and this high was higher than prior to it, and they're in close proximity. What's the filter? I'm not going to tell you that, but it's not very much in terms of difference between the price. And when you have that element, the market will invariably start marching back to those levels. It does not matter how many buyers are buying the market to go up there and how many short sellers. The proof of it is just look at a depth of market. Look at a ladder. Okay, a DOM. Look at those orders. There's no imbalances there. There's just as many short orders below the market as there is above, but yet the market will still march. It reaches to these levels because it's coded to do this. And if you do this for a couple weeks, you're going to see, oh, wow, yeah, this feels artificial. It feels like it's designed to do these types of things because it tends to repeat every single day at specific times of the day. It will do this. Now, let me go back to the times element. Every day between 8 o'clock and 8:30 in the morning, you want to sit down and determine where are the smooth locations in price action on the 15-minute, the 5-minute, and the 1 minute. So right away, you can see that this high here is relative to that one. And this one here also with that, this one being slightly higher than that one. So there's a lot of liquidity that's sitting at 17,820.75. Now, real important, it does not mean that it has to happen during that session. And that is the underlying risk that you assume every single time you take a trade. You're looking for things that are going to stack the odds of probability in your favor. It does not mean it's an absolute guaranteed outcome. See, I have students that literally take the time and waste their time in writing me an email. So how do I avoid taking losing trades with a inversion fair value gap or a mitigation block or the breaker? How do I know if it's a breaker or if it's a shift in market structure? Well, that's easy. You have to have a higher time frame premise and a directional draw where the market's going to go. And if you think it's going to go higher, when you see the market creating a short-term turn, we have the relative equal lows here and the market drops. You see that? So this drop down here, every up close candle on this time frame, all of this right here, that is your breaker. The most sensitive candle or range is going to be the last up close candle. Look at it like this. This range low, and see where the body stopped right there? We wick through it. I'm not denying that. But the damage is always done by the wick. And the range high there. That is your bullish breaker. But the range here from that up close candle that starts all these consecutive up close candles, all of that is technically the bullish breaker. But the most sensitivity is going to be seen in that last up close candle. The turn here at the bodies, that tells you what? Tells you the narrative. So what is it going to do? It's going to go higher. Okay, so what at that time would you focus on? Well, you have this short-term high here, the inefficiency that's traded to there. We want to see it trade above it and then act as what? Support, which would be a what? Inversion fair value gap. To do that, what would it reach for next? This high and this inefficiency. Does it do that? Yes. What are the bodies doing? Stopping just at that same level here. And more specifically, and my eyes didn't notice this when I put it up here. You see that little separation? That's a volume imbalance. You have to include that volume imbalance when you have a fair value gap, whether it be BIST or SIBI. And you can see the bodies being encapsulated by that. And now the market trades back up into that. The bodies candlesticks are trading inside the inefficiency. It wicks above it, but look where the bodies are stopping. And look where the bodies are over here. Where's liquidity at? Below here. Nothing in here. This is all very balanced price delivery because it's back and forth. Every other candle is overlapping the highest high and the lowest low, pretty much coloring it very, very, very good. Back and forth. All this price action is back and forth versus then we have all these run where we have separations in here, back down into that breaker there. This response right here to what it's just done there, that expectation and response in how price can react to levels like that, that's a nice little scalp right there. I mean, look at it. Move from 515 to what? 596. That's a good run. You can't get 20 handles out of that on a 15-second chart. You can if you know what you're looking for. Now also notice that we've created again high, lower high, high, lower high, but real close to one another. When did it form? Prior to 9:30. So we have 8 to 8:30, and then you study 9 to 9:30 because it's going to do what? It's going to look and seek the liquidity or inefficiencies. So here's 9:30 there, forming on the bullish breaker. It trades down, and then we have relative equal highs here. So we have these relative equal highs, this high and that high, relative equal high, and we have this area up here. So if the market's going to do what? If it's going to make a punishing move towards the shorts that want to see it drop because the market has dropped early on, 7 o'clock in the morning, and we have all these very clean levels. What did we just do here? We have a low. It was traded down into. It disrupted this little area in here. So it's made this area jagged. Remember I was saying earlier where the market's real smooth over here versus what it was doing down here. Where has the work been done? Meaning, if there is a group of traders that are very cannibalistic and they tend to be more correct than wrong, or if they are the ones that generally make the money more consistently than the ones that don't. You can see those things in price action. They're like fingerprints. You can see when the cannibals come in and they devour the pygmies. They go in there and just chew them all up. And it's where the market is made jagged price delivery. Always like this, folks. It's always plain sight. So we had these relative equal highs swept here. See that? Case study, bullish breaker to there. So how many candles did it take to do that? You screenshot it. How many handles did it run from the low to that relative equal high being taken out? And once it does that, keep the chart active with it on there, but then just make it very, very light. So that way you can still see it, but it doesn't have all of your focus. So that way it allows you to focus on, like, there's a fair value gap here. We traded down into mid gap, which is this wick here. Since price is above it, that makes it a discount array. Consequent encroachment of that trades to it. We want to see it run above this high here. So here's the relative equal highs there too. So now same thing here. You want to mute that in terms of its importance. And now you want to see, does it have the wherewithal to run aggressively for that 17,820.75? Any of this seem complicated to you? It shouldn't. I already know what you're thinking. When you talk about it, when it's happening, I can see it when you point it out. I just can't point it out when I'm doing it. Right. You're just learning it. You expect to be able to go out there right now if I turn this live stream off and you're just going to just know how to do it right away because you're placing too much emphasis on being fast. But the point is this: the very, very first thing you're doing as an undeveloped, unrefined trader, someone like my son Caleb, the idea is that you're looking for the smooth areas where the price is so obviously being defended and being presented and being offered for retail-minded trades. Look at that beautiful delivery right to that volume imbalance there, which is inside encapsulated in that SIBI. Went right to the high of that. Now, when you're looking at price, you're looking for the obvious, very, very, very smooth relative equal highs or relative equal lows. How do you know which one they're going to go to? How do you determine which side of the marketplace it's going to reach for? Because what this is going to do, it gives you the initial building blocks to understanding bias. So when you're looking at price action, you want to be able to determine what in this whole scheme of price delivery, what does it do in terms of resonating with you? Where would you feel confident? This is the part that a lot of my students skip over. They don't do any work with this part of it. They ignore it. They assume that it has no bearing on them. It doesn't have any basis or placement in them, okay? Because they want some kind of gimmicky little 1, 2, 3. I want to be able to do everything perfect right from step one. I don't want to have any adversities. That's not realistic because you're going to have a whole lot of adversities. And you have to invite that, be comfortable with it, because that's where it's going to highlight your shortcomings in your understanding. And it's going to also teach you how to overcome it. Wouldn't you want to know what your problems are in your relationship? And one person in this relationship has to be able to be reasonable. And at some point, the person that's reasonable has to say, you know what, this isn't healthy for me anymore. So that means I have to turn the charts off. I need to stop following this market on this time frame right now because it's not healthy. But you can't arrive at that until you do rule-based ideas and you break things down modularly, very simplistic. Nothing that I did today, nothing is complex. I outlined every single thing in advance and shown to you on a 1-minute chart. This would be further amplified if I was showing it to you on a 15-second chart. If you have the ability to look at a 15-second chart, study every level I've outlined here and the logic of why it was going to draw up into that 17,820.75 level. I gave you the bias. I explained to you in very, very bland commentary. It didn't seem scientific. I used analogies that I thought were very simplistic. When we're looking at areas that are very smooth, contrast this area up here, how that was very, very smooth. And remember these levels over here? I told you this one. In addition, if you weren't looking at that, that's the benefit of looking at 3 time frames. Because if you can frame an idea of why the market's likely to draw to a high or a low or inefficiency that is completely visible on 3 time frames, that it means you have 3 time frames telling you, hey, pay attention to me. And if that time frame or those time frames are in agreement with a relative equal high or a inefficiency above the marketplace, that means like something like this right here, or this right here, or this right here. They're all stepping stones inside the context in your overall narrative that the market was going to go here. When I first started the live session, what's the first line I dropped on the chart? This one. It was based on these 2 highs here. Why did I pick this high? Yes! What's the first thing I told you? The algorithm is going to go based on time. It has to be the right time. If it's not the right time of day, it is absolutely not going to work, period. But why and how is it that every single time I'm sitting down with you, how is it that the market does exactly what I'm saying it's going to do? How is it possible that this one single person can get it right so often in front of thousands of people? But 7 o'clock is a very key time. That starts what? The morning session. The morning session, AM session, starts at 7 o'clock in the morning. So you can have a model that says, I can't be in front of the charts between 8 o'clock and 8:30. And maybe you can't even trade a 9:30 opening bell for indices because you have to get ready for work. But it just so happens that the time elements in your personal life and geographically location in the world, that it allows you and affords you to look at the market between 7 o'clock and say 7:45. Worst case scenario, 7:30. If you're going to work with smaller time frames, you absolutely can use 7 o'clock to 7:30 as a model to do this very exercise. So your key times are this: 7 o'clock in the morning to 7:30. In that 30-minute window, you're going to look for relative equal highs and relative equal lows that have happened prior to 7 o'clock. And you're going to be looking through the time frames of the 1-minute chart, the 5-minute chart, and the 15-minute time. Now, Caleb, you're not expected to do anything else beyond that until I change the depth of what your focus should be. Right now, you're just having 3 charts up. Since the 15-minute time frame is pretty static, you only need to refer to it once. in the morning. And then your second chart could be the 5-minute chart. Then what you're doing is you're watching between 7 o'clock and 7:30, or 8 o'clock to 8:30, or 9 to 9:30 opening bell. You're looking for, where is the market smooth? Because still waters invite rocks. Remember being a kid walking and you see a pond that's real smooth. What's the first thing that jumps in your head? I need a rock. For what? Because you can't accept that. Our sinful nature says we have to disrupt that. So you pick up a rock and you want to throw it out there. Why? What's it going to do? It's going to cause ripples. That's exactly why a weak character individual in a relationship will have a wonderful relationship. Something smooth. Ain't no drama. And what they got to do? They go out there and they chase some thought. They go to the bar, they pick up some floozy or some silver-tongued fox that says all the right things for her. And you invite that disruption. Well, that's what the market does, folks. It's a dysfunctional family environment. And you have to be the one that says, not today, Satan. I know your tricks. So you have 3 opportunities in the morning to set the stage for a run that will build, if you don't have any understanding about bias, okay? If you don't know what direction the market's going to move in. When I go into other people's live streams and I say, note this, note that, here's the secret. This is a secret weapon. It's a bazooka when a BB gun's necessary. They cannot hide it from you. It's always there. And if you can contrast one side of the marketplace against another in this little area down here, okay, in this small little open section. But when you set up a framework of whatever you're going to study in the morning, if you're going to trade the morning session, your key times, you have to absolutely be in front of the charts between 7 o'clock and 7:30 in the morning, always New York local time. If you can be in front of the charts by 7 o'clock, this is what you're doing. But if you can't, you do the same thing at 8 o'clock to 8:30, the same thing at 9 to 9:30. This is your pre-market range. Write that down, because if you don't write it down, you're going to forget. You're going to call it the opening range. It's not the opening range. The opening range is the first 30 minutes after the opening bell. At the New York session, the first 30 minutes after 7 o'clock to 7:30, that is your pre-market range. 7:30 to 8 o'clock is your opening range. Oh, remember I was telling you I could trade every single hourly candle? Now you're starting to think. The gears are turning, aren't they? Oh. And obviously the 9 to 9:30, that's your pre-market range. And then post 9:30 to 10 o'clock, that's your opening range. There is no 15-minute opening range. This little range here that's being shown here with this rectangle, what I'm saying is this is essentially that 30-minute interval, whether it be 7 o'clock to 7:30 or 8 o'clock to 8:30 or 9 to 9:30, that pre-market range. In that range, what you're doing is you're looking at this line or beginning of that shaded area would delineate the 7 o'clock or the 8 o'clock or the 9 o'clock, where it begins at that specific top of the hour. And then this would be the range that makes up that first 30 minutes. Now, it's not obviously to scale, but I'm oversimplifying it for the purpose of teaching what I'm saying. Prior to that range, anything before or to the left of this, you're looking for equal highs or equal lows. Which side has it? Because that's your bias. It's going to draw to that. How do you know? If you have both, you wait for the first one to get disrupted. Because once that happens, then you work to the other one. That's your bias. So you have to defer and wait. Today, I gave you a clinic on how to determine bias. Whichever one has the relative equal highs or relative equal lows, that's a smooth area. It will be disrupted. Anywhere where you see jagged edges like this down here, see how it went jagged and then ripped higher. What is it telling you? I'm going to look for buy side liquidity, buy stops. This has been a trap. They engage traders to go short. They're trapped short on a breakout, or they're not trying to take the shorts out of the market yet. And that's why you see all this in here, a little bit creeping up. This is all balanced. That's why this spike stopped right at the top of the breaker here. Isn't that interesting? I've been talking nonstop. No chance for me to have another ad over, voiceover. It's all live. You watched me do it live. I explained the logic. And now here's the wonderful thing. You have the privilege to go back through your charts and backtest this, and your jaw is going to drop. The market trades down to the bullish breaker and then goes to the relative equal highs I told you to focus on. And then I gave you this one here, and I told you this imbalance is prior to these relative equal highs being taken. But this was where we were focused on, and look where we're trading at. In closing, in this price run, and we're not going to use all of this, if we have this segment of price action, if I'm identifying this area up here, more specifically, let's be honest, because this is the one I drew your attention to first, so we'll stick with that one, even though that other one was later mentioned, even before it got traded to. Every single day, you break down the chart starting at 7 o'clock in the morning, have 7 o'clock in the morning all the way till 11 o'clock. And you want to have your 15-minute time frame, your 5-minute time frame, and your 1-minute time frame charts, and annotate. And it may require you to have multiple charts from that individual 1-minute chart where you're zoomed in and you're annotating something specific that are very salient to you, because most of you may not have trusted this as a bullish breaker. If you go back through all of this price run here, what you're going to do is you're going to focus on the points that make the most obvious sense to you, that you could see and it says, you know what, I understand this. Even though ICT pointed out this breaker, you may have noticed it. Maybe you didn't. If you didn't, that's not your PD array. If you noticed that it traded down into this fair value gap right there, inside of this old SIBI, which is essentially where? About midpoint between where we expect price to trade to, which is above these highs, and where it traded from. So if we see where it's likely to go and where it went from, where it originated from, where's the midpoint? Well, let's do a simple measurement. Here's your fib. And we're going to say something above these relative equal highs. We'll just randomly pick an area right there. Okay. I'm just being very bland. There's no real reason I'm picking that price. It's just simply slightly above the relative equal highs. There's no other logic, simply that. Okay. So I'm not trying to complicate anything. But if you take that and you go down to the lows that are relatively equal, not the lowest low, that's the manipulation. You want to use the relative equal lows like that. Okay, you see that? And then you have essentially the midpoint here. In close proximity to that, you have this fair value gap and you have this fair value gap. And this one here can be used, even though it's a little bit above equilibrium, because we didn't take this high and that high out, which I was outlining to you real time. We didn't take that out yet. We didn't take out these two relative equal highs when it was trading down to the break. But what happens when it trades up here? And then at real time, I said, watch this fair value gap. When we were trading right there, I said, watch, and here we are, we're trading this fair value gap here. And then takes off and runs to where we are waiting to see it deliver. The smooth areas are going to be attacked. The sharks are going to go to the still water. Why? Because as soon as someone in there starts shaking in fear that their stop's going to be taken, that still water will ripple and that triggers a frenzy and the sharks are going to go right there. You don't trade into levels where the sharks have already had a frenzy, and that's down here. They've already done the work. There's been an attack down here. How do you know? There's been the great disturbance in what price was doing and how it's delivered. It's jagged like shark teeth cutting through the side of a whale's body. It's been damaged delivered. You can see it. It's physically represented in the jaggedness of the swings going down, where we don't see that jaggedness up here. It's nice and smooth, real inviting. It's safe. Put your stop loss above me. But you have to go through all of this price action in here and determine what price level makes sense to you. Which one resonates with you? Do you see the fair value gaps where I was outlining before I did it? Did it make sense when I was drawing them out? Did you change your expectation and get fearful that I'm wrong and it's not going to go up there because it had this drop here? What's occurring here? The only thing it's doing is at 9:30 during the opening range, it's doing what? It's creating a Judas swing, something that's opposite to the real move. The real move was given to you with these highs. It's going to go there. We can see how that SIBI becomes an inversion fair value gap here, and then it sends price higher, retraces down, and then you have your second leg redistribution, and it sends it to the smooth area that makes up this market maker buy model. So when you're looking for the bias, the easiest, most scientifically proven, 9 out of 10 doctors approved, ICT has nailed it down to a science of wherever the smooth equal highs are or smooth relative equal lows are at the beginning of 7 o'clock to 7:30 or 8 o'clock to 8:30 or 9 to 9:30, you have 3 opportunities, 3 chances. As each one of these time windows passes by, so at 7 o'clock, we formed the relative equal highs. And then at 8 to 8:30, we didn't go up there yet. So that means that, 9 to 9:30, chances are that's the run. See how that does that? It increases the likelihood of it going there. It doesn't diminish it because it's building up more trust in that area right there. So the framework begins at 7 o'clock in the morning. Start looking for relative equal highs to form. Not before. Key takeaway is not before 7 o'clock. At 7 o'clock, look for them to form. Big takeaway there. If you're looking for relative equal highs prior to 7 o'clock in the morning, you may get it, but many times you're expecting the London session to be completely overrid, and it's most times not the case. So it kind of like builds in this filter where you're not trying to demand that the run on London is removed or dismissed because of price overlapping it and going back over top of it, because the general consensus is we could see the higher low of the day form in London. So if it's bearish or bullish relative to a higher time frame draw, which is not necessary, notice I haven't even used that here yet. Only thing I used was a 15-minute time frame, a 5-minute time frame, and a 1-minute time frame, and I was framing on the basis of time because I understand my algorithm. I understand what it's going to do. I understand exactly what these markets are going to do. Every single day. It will not stop. It will not be hidden from you, but it can be disrupted by manual intervention. And that will always cause me to lose. It will always cause me to be incorrect, because that's something that no one can predict. It's their casino. If they want to come in and disrupt everything, it is what it is. That should be the number one reason why you should never over leverage, because that is always looming. And we're in a condition in the marketplace right now, in geopolitical tension and turmoil, that is expected to unfold at any given time. And if you happen to be over leveraged when it happens, and probably end you and take you out of the game entirely. And all of that is avoidable if you don't over leverage. If you trade with one contract and you try to capture moves like this, I promise you're going to beat the socks off of every one of the live streamers out there. It's one or the other. And if there's two extremes, above and below the range, that's relative equal high and relative equal low, then you just wait for one of them to be disrupted. And just sometimes you'll miss a move. Sometimes it'll do it and then you won't get a trade. Who cares? When you back test this, you're gonna see, like, what am I worried about, man? Like, this is so many times offered to me every single week. Right. That's the mindset you need to come away with. Not, I got to trade every single day. When it's so obvious, that's the ones you want to trade on, because retail is going to have every hope and prayer hanging on those relative equal highs, thinking it's resistance. Hopefully you see that when we're doing this, we're not trying to be smart. We're not trying to be more popular than somebody else. We're in here to try to make money so that way you can make your ends meet. That's it. Enjoy studying it, because it's important that you do enjoy it. Because if it's daunting and you're not really seeing any kind of fun characteristics in it, it's going to be very hard to stick with it.